All right, what's up, everyone? Today's video is really going to be about filtering companies. So this is exactly what I would do if I first heard of a company, and I would try within, honestly, seconds. But I think that's the power of really good filters. And if you have a really good filter, then you can really churn through a lot of companies. With that said, the tighter your filters, the more likely you will miss the random diamond in the rough. So there's sort of a trade-off because if your filters are too tight, then you could miss some really interesting circumstance that doesn't look interesting at first glance, but you really have to dig deeper. But for today's video, I asked ChatGPT to give me 30 companies that I have never heard of. And then because I look at so many random companies, I'd heard of probably half of them. So I just kept asking it until I actually got 30 that I had never heard of. So we're going to go through these 30, see if there's anything interesting in there. And but mainly the core focus of the video is really going to be teaching how I would filter and what are the things I would immediately look for. So these are my filters. They won't necessarily be your filters. Um, but these are the things that I would do immediately to see if something is interesting or not. So with that, let's just dive right in. So I use Koyfin. I'll probably leave a link or something in the bio, but I think Koyfin is awesome. It's this kind of like a this is savage, but kind of like a poor man's Bloomberg. Um, but it's very powerful. So it's not an octacoifin. It's more of a compliment, really, because I think it's a great value. But these are 30 companies I've never heard of, and we're just going to go through, see if there's anything interesting in there. All right, let's get to it. So I'm going to, real quick, I just want to make sure that we have the list up right here. And okay, 1 second while I get this sorted. Okay, perfect. All right, first one, ADUS. So I have a shortcut where I've created the income statement, basically. And you can see right here, the most recent quarter, we have revenue growth, gross profit, EBIT, stock-based comp, and the cash flow. You get cash from ops minus capex equals free cash flow. This is all what I manually set up. So this is all set up. You can see all this financial information immediately with a shortcut. Diluted shares outstanding. You can see what share count has done, market cap, net debt, enterprise value, goodwill. And then you could even look at see if there's repurchases. You can look at net working capital to just off the brain, invested capital, stuff like that. Okay, so Addus Home Care, 11% growth, 100 million EBIT, pretty good free cash flow conversion to like 20 times cash flow for 10% growth. Interesting, but I'm typically looking for over 20%. That would be my filter. So if something is under and doesn't really look like it's accelerating, this would be an easy pass. Even though it looks like a pretty solid business, it's not like cheap enough where I'd be really interested. Okay, that's the first one. And we took a bit of time just to explain the highlights, but now we can really cook through these. Okay, E plus, really variable. I mean, negative growth, then back up. So I'd be asking, why did that happen? Pretty thin profit margins, 160 million EBIT. So this is the current. I like looking at the last 12 months. Pretty good free cash flow conversion. Must be really seasonal, but 240 on that. A little bit of net cash on 18. So it's pretty cheap. But I would be curious why things were jumping around. And I would imagine it's because we have some big acquisitions here or something. Um, Not crazy amount of goodwill, but a bit higher than I would like, plus variable revenue, thin profit margins, I would pass. I'm really trying to just look for companies that are up and to the right, making and are fairly inexpensive. It's nothing. Okay, once again, must be some weird variability here. I mean, it is probably a biotech company, and it's really jumping around. So there's probably some licensing here. Free cash flow is negative, ton of debt, easy pass. Okay. EXLS. Once again, I never heard of any of these companies. Okay, we can see a lot of green, a lot of growth. Things have slowed down. We're seeing some deceleration. 240 million EBIT, 120 of free cash flow. We got a little bit of debt, a lot of goodwill. I would pass on 9% growth. So that was what, 20 seconds? So it is possible to just cook through these. Okay, we're on number 5. Hassie, never even heard of this. So this must be some sort of REIT, or you got infrastructure in the name, 100% gross profit. So sometimes the system, if the financials are a little bit wonky, you won't quite be able to put them into neat income statements, especially if it's not a normal business. 70 million, a lot of debt. Yeah, I think this is like a infrastructure REIT or something. That's just not quite in my circle of competence, so I'd pass. Okay, ICU Medical. Growth doesn't seem like it's going anywhere. Margins are all over the place. Interesting free cash flow conversion. A lot of debt, a lot of goodwill. Easy pass. Okay. LivePerson. Negative revenue, negative margins. Easy pass. So that was 5 seconds. Like I said, the tighter your filters, you might miss something. LivePerson might have some sort of hidden revenue segment that we're not seeing. So if you really want to be thorough, you can check. So LivePerson is another shortcut on Koifin where you can look at the filings. You can just look at the last 10Q and head over to management's discussion. So, okay, what are they interested in here? Key metrics. So revenue decrease primarily driven in hosted services. Decrease. They completed a sale. Limited the consumer segment. So I see nothing about a segment that's growing or anything. So if you really wanted to be diligent, you could do that and then really determine whether that's an easy pass. But for this video, I'm just going to show you my tight filters. We're not going through ABC, looking at all the investor relations sites. So for the sake of this video, we're just going to try to get through the 30. All right, growth is pretty slow, pretty thin margins. Cash flow conversion is fairly low, a lot of debt. Yeah, that would be a pass. So as you can probably tell so far, my filters are growing revenue, profitable, low debt, and then I'd be maybe interested. Okay, no growth, thin margins, right? 4% EBIT margins, negative free cash flow that quarter, a lot of debt, a lot of goodwill. Easy pass once again. So nothing is really interesting, ChatGPT, but we'll see. Still early. We're only on number 10. Okay, the Buckle, no growth, pretty solid profit margins, pretty decent free cash flow conversion. Just a little bit of net debt. So 1.9 billion on 260. So it's like 9 times free cash flow. But the business is contracting, so I'd pass. But it'd be something that maybe for like a typical value investor might be interesting. I might have heard of that one actually. Let's see. ChatGPT giving me stuff. It's not even a company, but this is just another ticker that was close to the one that was given. Okay, so I have heard of Backham before, so this is kind of cheating. growth is accelerating slightly, strong profit margins, 150, but free cash flow conversion is weird because they spend a ton on CapEx. So it's pretty solid cash from operations, but they spend a ton on CapEx. Net cash is interesting. So on EBIT basis, it's really 150 and 630. So it's trading for like 40 times trailing EBIT, but it's accelerating. You can just look over the past. Yeah, it's definitely grown. So this would be interesting, more of a compounder type business, but free cash flow negative. They're spending a lot on CapEx. That would be the thing you have to understand. So if you look at a return on invested capital or something, we can look at their net working capital, like 450 million, and then net PP&E, so like 1.4 billion maybe on invested capital, and 150. So that's not like super amazing. Maybe 12% return on capital, but it might be increasing. But just wouldn't be that interesting to me. But maybe for like a more compounder type investor, it might be interesting. Okay, so that one took the longest because it was most interesting, and then you kind of have to see if it makes sense in the context. But this is really just pattern recognition, just building that pattern recognition time and time again. So Boot Barn, I guess I've heard of that, but I've never looked at the stock. Growth is severely decelerating, thin profit margins, and debt and goodwill. Easy pass. Wow, ChatGPT is out here giving me fake companies. I just have to start. That's not even a kicker. It's the second time that's happened. Once again, some hallucinations, but we're working through it. All right, Kohu, huge revenue drop. That's affecting margins, so it must be a pretty fixed asset business. Um, we got some cash, a bit of goodwill. So I don't know. They must be selling down a business segment or something because that's a pretty big drop off. Let's see if that makes sense. Check out the 10Q, management's discussion. Okay, so they're a semiconductor company. They completed a big acquisition there. Yeah, they might just not be in like AI necessarily, but some of their other segments are dropping off. Not that interesting to me. Okay, Qterra maybe? Easy pass. I mean, this could be a short, honestly. I might be interested in adding this to my short list. I don't really short, but just if something was really bad, you never know. Okay, that's terrible. Okay. Designer Brands Inc. All right, we're about halfway there. So good job. We've gone through 15 companies and it hasn't been 15 minutes yet. So growth hasn't grown, really nothing. Super thin profit margins. Free cash flow is lumpy, big debt, some goodwill. Easy pass. eHealth. I might have heard of this one before. Might be like a healthcare marketplace. Okay, growth is all over the place, but it seems to have stabilized. They're really not making money. This is a huge, they must have had like a goodwill write-off or something. But now they're starting to make money. No, it doesn't look like there's a goodwill write-off. I'm really curious what that would be. With some net cash. So I would be curious to go in Q3 and look at what happened. So we can look at the Q3 10Q and try to figure out what happened. That's really what you're trying to look at, financial statements, to get a sense of the questions that you need to figure out, and then you can go find them out. Okay, so all right, here we go. This is the income statement, total revenue. It looks like, what is the big segment that really jumped up here? This is very strange. Customer care and enrollment jumped up, but this went down. I mean, I guess they were just losing a ton of money anyway. It must be, oh yeah, it's a healthcare marketplace, so it's just extremely seasonal. That's all it is. It's extremely seasonal, so some quarters when they're not enrolling people, they have still the same cost basis, so it's not like they ramp up and down their agents or something. But the enrollment period is Q4, so they probably just make all their profits in Q4 or something. Um, yeah, I wouldn't be that interested. A little too lumpy for me. Another one that ChatGPT is hallucinating on. Okay. Forward Air. Let's see. Okay. This seems like it's accelerating. Free cash flow is kind of all over the place. And it's accelerating probably because they did a huge acquisition. You can see goodwill jumping up. So I wouldn't be that interested. Okay, GCP. Wow. Okay. We're going London. Big. Wow, this is. Yeah, it must be another REIT or something. That's past. That's like the same one we looked at. Okay, nothing really interesting that so far. Not even anything that I'd put on my list to look at deeper. All right, revenue is really variable, really thin profit margins, a big debt, big goodwill, easy pass. Each. Okay, healthcare services group is the next one. This is number 22. So we're 2/3 of the way there. Growth's not really going anywhere. Really thin margins. Free cash flow conversion is lower, about half of EBIT. Balance sheet is decent, but a lot of goodwill. Pass. Hexel. Okay. Growth is decelerating quite a bit. Fairly thin profit margins. Free cash flow is lumpy. A lot of debt. That's a pass. Okay, hopefully we get something in here. But this is just the name of the game. It's like fishing. You gotta look at just be patient and wait for the big one to come to you. Okay. Growth looks like a tiny bit of acceleration from 2 to 8. Margins are decent, but you got some debt, a lot of goodwill. Looks like that's why it's accelerating. Not that interested. If growth is accelerating because of acquisitions, I'm not that interested. I'm more interested in organic acceleration. Okay, revenue is negative. Good free cash flow conversion, but still really lumpy. Must be some accounts receivable to come in at random times of the year. Balance sheet looks decent. Growth is down. I'm passing, but otherwise could be interesting. McGrath Rent Corp. Okay, growth is pretty lumpy, but it's decelerating fast from 40 to 14. Margins are decent though. This is weird. I guess they're just spending a lot on capex, and a lot of debt, a lot of goodwill. Passing once again. So I hope you don't view this as a waste of time if we don't find anything interesting. But that's kind of the point. Is when you're filtering, there's gonna be a lot of garbage, but there's gonna be one thing that just sticks out, and then you go digging, and then you find it's more and more interesting, and it's just a treasure hunt. Okay, this is an easy pass. Growth is really doing nothing. Super thin margins. Um, it looks like I think Koyfin is just wrong here. It looks like they still have debt, unless they sold off a big portion. Something weird is going on with Q4. Oh, huge goodwill impairment. So they basically took that down. Yeah, that would be a really easy pass. Myriad Genetics. Okay, we got 3 more. Growth is all over the place. I can already see that. Negative margins. Yeah, that's bad. Losing a ton of money. Okay, we're almost at 30 companies in 20 minutes, so we're cooking through these. Growth is nothing, really thin margins. Interesting cash flow conversion though here. So you can see that we have 455 of EBIT and 700 of cash from operations. So you can tell that that's all from working capital. So if you go down here to, sorry, your working capital, you can see that it actually has the change in net working capital has been really positive over the last 4 months. So you can see that there's a huge rationalization in inventory. So inventory went from year over year from 265 to 170. So that was almost 100 million benefit. So if you remember, 700 million minus 455, so that's 250 about working capital that was positive for free cash flow. So this is about 100 of that. And then accounts receivable, 31, 3.1 billion and 3.6 billion. So that's bad. Obviously, the accounts receivable are going up, but accounts payable went up by even more. So about 500 minus, that would be a hit to free cash flow because accounts receivable would go up, right? If people aren't paying you, that is cash that is not coming in. But if you are not paying your vendors 700 million, that's actually a 200 million benefit. So you can see that through inventory and increasing accounts payable, that's why free cash flow is so much higher. So once you start looking at all these companies, you can sort of see the picture that the financial statements paint, right? The financial statements are like a picture, which is 1,000 words of a business. So I would be curious about why payables are going up so much and why they've been able to rationalize inventory. Yeah, that would be the main question that I would ask here. I'm not really that interested in it, but 700 million in free cash flow on 7 billion enterprise value is 10 times free cash flow. Seems like it's valued just about right, not like super cheap or anything. Okay, the last one, Perficient. This is the last company. Okay, hopefully now growth is nothing. Margins are pretty thin. It's not that cheap. We got some goodwill. So nothing is that interesting. After 30 companies that I never heard of, I would pass on all of those, except I'd maybe short Cutera. You never know. But just to give you a sense of something that would be immediately interesting off the bat is I don't want to do NVIDIA. It's just too obvious. What do I want to do? Something like Zscaler? I don't know. Not something I own right now, but let's just see. Looking at all those kind of not that good companies, and then we look at Zscaler. Okay, we see that revenue is decelerating a little bit, but still over 30%, so that's interesting. Really high gross margins, about break even, and some good progress on the bottom line, and then really strong free cash flow. So, right, EBIT is a negative 140, but free cash flow is 600. So that's like a $750 million difference. So where does that come from? So even if we knew nothing about that, I would know that that's a software company, almost guaranteed. And so if we look at the net working capital, we can almost guarantee this is negative net working capital business, right? Yep, almost a billion net working capital. That means they're getting about $1 billion of cash up front before they actually have to pay anyone out. And so we can see that this deferred revenue, 1.4 billion, and then this is current and non-current. So deferred revenue, they have about 1.6 billion, and then 500 million in accounts receivable, very little payables, And so that's how you get to negative 1 billion in net working capital. And then that's just why there's such a huge gap between free cash flow and EBITDA. So they get the money up front and a subscription model. People pay a year in advance. And so it's a really good business model. So $26 billion enterprise value on 600 million. I would say that's pretty expensive for growth decelerating. So I actually wouldn't be interested in this, but it would be one that I would certainly put on my watch list or something like that. So it's way more interesting. We could even look at something like what? So this is a random example. This is a Microsoft vendor that has been doing really well. So you can see that revenue is actually accelerating, about break even on the bottom line. It's a software business, so we have good free cash flow conversion. So 40 million on 1.7, strong balance sheet. So this would be something that would be like, oh wow, I got to dig in, find out what's going on here. So those are two examples after the 30 of things that I would actually be interested in, and then I might put on a watch list or something. And so, yeah, that's pretty much what I have for you today. Just these are my filters looking for growing companies, essentially companies that are growing their free cash flow with strong balance sheets and that have good capital allocation. And you can usually see that through a lack of goodwill, or if they're buying shares. I didn't even really mention it, but you can see the share count. It's interesting when companies IPO, but the share count hasn't really grown that much here. So this sometimes there's errors on it if they're like a warrant comes due or there's like a big options vesting, but then it comes back down. So yeah, AvePoint is actually pretty interesting. If you want to dive deep on it and let me know what you think, I have my own thoughts, but that would be something that if it would showed up on our list of 30 companies, I'd be like, oh wait, this might be interesting. We have to dive deeper. But those are 30 companies in less than 30 minutes, 32 actually. So you got some bonus companies. And like I said, tight filters really allow you to just bust through companies and look at them, but you might miss the diamond in the rough. So it's important to have some sort of filter, or if there's maybe some acceleration going on, then you can really dive in and see what the true picture is. So I hope you enjoyed that, but that's how I go through a company in less than a minute, maybe even some that were 10 seconds. Hope you learned something, and thanks for watching.